What's fundamentally changed on the back of the Fed and BOJ?
I think, look, I mean, the markets went into last week with a great deal of anxiety around what the BOJ was going to do. Of course, they surprised, and we're still trying to understand what that surprise means in the greater context of global bond markets. And this fear of now an anchoring of long-term rates in Japan, enforcing that money overseas, is what's really gripping, I think, bond markets now for the last 3 or 4 days. And our view is a little bit more nuanced. We think that what the BOJ did does not necessarily mean that all this money is going to spill out into the global bond markets, but really the jury's still out and it's still too early to tell.
So effectively they've injected some risk into the long end, which is what the long end's meant to be about, isn't it?
Look, at the end of the day, I mean, I think that they want to have a steeper yield curve, and that's been the goal, at least the narrative that's been trying to be formed since really August, September. And I think at this point, you know, if they can get the rates to stop heading lower, then maybe they'll win on that. But the problem is there's a scarcity of high yielding assets. There's still concern around where to put your money, and I think that that's what's benefiting G4 bond markets.
To me, that sounds like normalization. Anton, come in on this.
I think it's a bit early to say it's normalization. As you said, the long end has got to be the risky part. It's also got to be the part that flattens magnificently when there's a big risk-off moment. I think we're very far away from that. Still, the Bank of Japan's last week when they went out, obviously tried to steepen the curve, but it's not been impressive. And what is interesting from an overall positioning standpoint, first that I think we're far away from normalization still, is that all those curves have moved in sympathy. So they've all moved in terms of steepening or flattening at the same time. So it's, as you said, that probably comes to your point of anxiety as well. Everybody's doing the same trade at the moment. I think we're very far away. Plus the problem is the long end is also anchored to inflation. And where is inflation? So, you know, if you don't engineer inflation, you can have a long end to be quite low for quite some time, and steepening will not come.
It seems to me the market is still struggling to understand fully what the Bank of Japan change actually means here.
Yes.
And clearly there seems to have been a view that Mr. Kuroda is concerned about the stability of the banking system and wants to enact a yield curve policy that protects the banking system to a certain extent. But where does that leave you as an investor? Should you be further out on the JGB curve here now to try and take advantage of this new strategy? Well,
in many ways, you've actually kind of capped your potential losses, right? You kind of have an asymmetrical kind of payoff where you know you can actually sell back to the Bank of Japan at near zero, if that is indeed the case. But I think a lot of the confusion lies around, similar to what we experienced when in the beginning of QEs. Back in 2009, 2010, everyone's like, what does this really mean? It's gonna be hyperinflationary, gold's gonna go through to the moon. And now we're trying to understand, what does targeting really mean? What if they actually succeed and no one actually sells bonds? If you know that you have an actual buyer in the wings, why would you actually sell your paper? So it could create these perverse outcomes where they don't actually even have to step in to buy the bonds because there's going to be kind of this home country bias. And I think it's still too early to tell all those things. I think, I mean, obviously the markets did react. I think it was more of a relief rally that we got through the last couple days. But to extrapolate what we've seen so far as a further anchoring or crushing of yields just because what Bank of Japan did, it's not clear to us.